Each year, Microsoft Research hosts hundreds of influential speakers from around the world, including leading scientists, renowned experts in technology, book authors, and leading academics, and makes videos of these lectures freely available.
Our next speaker is Tobias Preis, now from the University of Warwick. We'll be talking about quantifying economic behavior with big data.
Thank you. Good morning, everybody. It's a pleasure to be here in Cambridge. Thank you very much for inviting me. I'm going to talk about recent research entitled Quantifying Economic Behavior Using Big Data. And if I talk about big data, then one main source of information is all collected by the information we produce by interacting with technology, like our smartphones, like notebooks in the audience. And this produces huge piles of information. And one part of this information is shown in the background here. So that's a map of photos taken and then uploaded to Flickr in 2012. So nothing else is shown in the background, so you can clearly see the continents. And that's one form of internet data which opens up for us the possibility to develop new and adaptive models of human behavior. And if I talk about human behavior, then I mainly mean decisions. So decisions we take in the real world. So the decision to buy or sell a certain stock, so maybe Microsoft, and how we actually reach this decision, and maybe how we can also track this from a scientist point of view. Traditionally, these decisions are recorded at the exchange place. So when all these exchanges became electronic marketplaces in the 90s, in the early 90s, then we had the possibility, the opportunity to study huge amounts of information, financial transaction logs when he decided to buy Microsoft stocks. So then the order went to the exchange place, got executed there, and then was one data point in the huge database, maybe at NYSE or some other places around the world. And this is then also one very early form of big data and information we can study in order to understand human behavior, in particular economic behavior. So that's one part of big data we study, but we try to complement this information by looking at huge records of internet data collected by the fact that our everyday life is impossible to organize or to organize various aspects of our life. So whether we would like to go to a restaurant, so we look up certain maps online, or whether we would like to look up the maybe manual of this restaurant before. So there are various types of information requests and searches we send every day. And one search engine which actually records this information is Google. And this was the first internet data set we actually looked at. And we got involved in this kind of research in 2010 when we analyzed information provided by Google by the tool Google Trends. And this is just an example from a publication published in that year in the Philosophical Transactions of the Royal Society. You see three curves for the different terms: subprime, Lehman Brothers, and financial crisis on a weekly basis. So that's the granularity of this data set. Google Trends is offering this on a week-by-week basis. So for very frequent terms, you even get daily information, but the majority of keyword comes on a weekly basis, so weekly updates, and it starts in 2004. So what you can see is that very surprisingly, or not very surprisingly, in the third week of September 2008, many people got interested in the term Lehman Brothers, which at that time caused a huge financial shock wave when they filed for Chapter 11 protection in the United States in this week. And yeah, at the same time, the financial markets were in a quite stressed state. Based on this information, we looked at the question whether we can use searches on company names in order to say something about financial fluctuations. And in this early paper, we discovered a correlation between how often people Google for company names like Apple and how many stocks of this company are exchanged in the same week. So it's more or less nowcasting coincidence. In the same week, we have an increase in search volume, and we find that in the same week, it's more likely that more stocks of, for example, Apple, so AAPL as the ticker symbol of Apple, are exchanged at NYSE. And that's a pattern we find for, on average, for all 500 components of the S&P 500. And this was for us the starting point to dig into this data set and the question to which extent these online resources can tell us something about financial behavior. The obvious question you might ask now is, okay, there's a link, there's a connection between how often people Google for company names and how many stocks are exchanged. So is there something we can maybe tell about the price fluctuations? And this was the question we started to ask roughly 2 years ago or even earlier. And in order to explore this question, we constructed a very simple strategy based on search volume. So if we are looking at the number of Google searches for a given keyword, and this happens in week T, and if the search volume is lower than the average over the past weeks, so in this case, the past 3 weeks before, then actually we buy one financial asset, and in this case, we apply this to an index, and the index is a very commonly known index. It's the Dow Jones Industrial Average. And we buy the index in the coming week, so this means we are opening a long position, buying the index at the first trading day of the coming week, and close the position 1 week later. That's the first part of the strategy, and vice versa. If there are more people interested in the keyword in question, and I will tell you in a minute which keywords we looked at, then we take the opposite action. So on increases in search volume, we sell the index in the coming week, meaning we are opening a short position at the first trading day of the coming week, and we keep this position for exactly 1 week. So if we do this, and we do this on an ongoing basis from the start of the database in 2004 on a weekly basis, then you see in blue what happens or what would have happened if you applied this strategy, and applied based on a term, and the term is culture. So we looked at the fact how often people have Googled for culture week by week. If there were more searches for culture, we sold the market. If there were less searches for culture, then we bought the market. If you do this, then you end up in this scenario with a return of roughly 5%. And that's not really that much, in particular if you compare it to a benchmark strategy. And the benchmark strategy in this case is just buying the index in the very beginning of 2004, and holding the position until the end of the period we look at. The buy and hold return is 16%. So then you have just 2 numbers, and you know, okay, buy and hold is a little bit more than the Google-based strategy. So that's also maybe not really meaningful in order to evaluate the situation, what you're really looking at. And for this reason, you also see 2 dashed lines here. and the dashed lines visualize the ±1 standard deviation of completely randomly investing. So this means every week, just randomly, you buy or sell, and you do this in 10,000 different portfolios. Then you have a distribution of returns in every given week, meaning that you can calculate the mean value and the ±1 standard deviation at every week in this time period. So that's a term culture, and probably one possible conclusion of this slide could be that culture has not really that much to do with stock markets. So let me show you a different example. What would have happened if we would have used the term debt instead? So now we know we had a financial debt crisis in recent years, and if we would have used the input on how often people have Googled for the term debt on a weekly basis, then we would actually have outperformed the market and reached 326% return in the same period. So compared again to 16% buy and hold. So that's something we published this year in scientific reports, and that's open access. It's freely available. We gave a number of interviews afterwards. 326% were quite exciting for many, many people, so including also the Financial Times, which reported this finding on its cover some weeks ago. But it's not only about one keyword. It's not about the 326%. So we looked at a number of keywords. So that's a set here showing 98 keywords. And these keywords were generic keywords rather than company names, what I have explained before. And here you can clearly see that a term like debt turns up very prominently. So this was actually the best keyword in this set of keywords. Now at a different scale. So this is normalized by the standard deviations of random strategy returns. So meaning that debt results in 2.31 times more than one standard deviation of random investment. So you see that there are financially related terms, so stock, portfolio, inflation, housing, Dow Jones, and many others. You also realize very quickly that terms like color are something which turns up very prominently, and so it's not really clear how to evaluate the situation, but there might be a certain bias towards financially related keywords in this top part of this ranking that's shown here on the left for the entire time period, 2004 until the end, so that's February 2011, and on the right-hand side, qualitatively similar results if you just use subsets of this time period. The main question we asked then was, can we actually find a way in order to quantify what the fact is, or what's the quantity which makes a keyword successful? And in order to do this, we used our instinct that more financially related terms might be the key issue. And so the next question was, can we actually quantify how financially relevant one term is? And in order to do this, we created something like a financial relevance index by counting how often a word like debt or color or others are used in the issues of the Financial Times, which is one major outlet for financially related news, and normalize this by the fact how often these terms are used in general literature. And general literature, so one proxy we used in this case was how many hits Google finds if we are asking for this term on Google. By building this ratio, we found a very strong and significant correlation with return in this ranking here, showing that indeed financially related terms tend to perform better than other keywords. Now you can extend this approach. You can ask, okay, what Google or Google users and their behavior maybe how this maybe relates to the trading of stocks. So I explained you that we used a strategy that we sell on increase and buy on decrease. So this was just a hypothesis, so we didn't know in advance that this is actually the key, but it was guided by the idea that information gathering is actually time consuming. And you might invest more time in order to make a more difficult decision rather than making an easier decision. And that's backed by concepts in behavioral science that link to loss aversion, that you're more afraid about losing five pounds than actually missing the opportunity to gain 5 pounds. And we then directly compared these strategies for a well-defined set of keywords. And these keyword set was the Dow Jones Industrial Average. Here's one example shown, that's Intel. And the top panel shows the result of the original strategy. So an increase in searches for the term Intel. We sold Intel stocks in the coming week. So again, first trading day of the coming week and holding the position for 1 week. And this results in 549%, which is also just one example. So not really telling you much. And obviously, if one strategy is positive and you are reversing the strategy, so on an increase in search volume for Intel, then you buy stocks in the second scenario, then obviously you have to lose money. And so given that this is not symmetric due to the logarithm of the return, you end up with minus 85%. That's one example. If you look at the complete set of 30 stocks forming the Dow Jones Industrial Average, then you see that the mean value of all these returns is significantly positive in the left scenario, supporting the idea that information gathering and taking the time for looking for information is really linked to negative stock market moves afterwards. And on the right-hand side, obviously, if you have one positive mean return for one set of this strategy and you're using the reverse strategy, then this has to be negative. So this is the information we used based on the fact that Google searches capture human information gathering behavior. But that's not the only part of information or information resource we can use in order to look at financial fluctuations. So we moved then to the question whether maybe other resources capturing similar behavior show similar patterns. And one major part of information is Wikipedia, which provides also the information on article usage. And compared to Google, where we had only access to a very limited number of time series because Google is restricting the download bandwidth, so the number of downloads per day, per hour, and then also per IP. We have the advantage by looking at Wikipedia that we can download the entire database. So this means we can look at the entire Wikipedia corpus, but also at the entire usage database for these articles. And if we run exactly the same analysis, so using the information whether people have visited Wikipedia articles and if this number increased for a given article, then actually we sold the underlying asset. And again here, in order to make this comparable, we used the Dow Jones Industrial Average. If there were less people interested or less people viewed a Wikipedia article, then we bought the Dow Jones Industrial Average. The blue distribution here shows something similar as the rankings which I have shown before. So this is the distribution based on a category which is defined by Wikipedia itself. So it's the category on financial topics, which roughly contains 285 financially relevant articles. And the distribution depicts the outcome and also the mean, of course, what would have happened if we would have traded based on the fact how often people have accessed these 285 articles. So the mean is significantly positive. That's a very exciting fact. In particular, if you compare it to the random strategy distribution, which is shown in gray in the background. Wikipedia gives you not only the information on how often these articles have been viewed, so you can also construct time series based on the information on how often these articles have been changed over time. So that's something we call the edits, Wikipedia edits. And so this is something which is not significant, so not distinguishable from zero, the mean value, but this might be interpretable in two ways. So maybe there's not really that much information in Wikipedia edits, or the second possibility is that just the number of edits is not that high compared to the number of views that we can really see a meaningful signal in this historic analysis. So now I have shown you many examples where we can actually say something about subsequent stock market moves, at least historically. So let me maybe show you a counterexample. And a counterexample is, for example, if we look at another very unrelated category on Wikipedia, and that's the category for actors and filmmakers. So the nice thing about the actors and filmmakers category is that they have a similar number of articles combined in this list, a little bit less than 300. And this shows that in this case, we are more or less obtaining random behavior. It's more or less overlapping with the random distribution, random strategy distribution in the background. So this was the starting point supporting our original findings in the Google case. But then we went further. So we had the possibility to look at the entire database. And so we built our own category. So thanks to our students, in particular Chester Kerm, who is the first author of this paper, we used LDA in order to get up to 100 categories from the entire Wikipedia corpus, and then looked at search volume generated on Google for these article titles, which fall into these categories. So for each of these rows, we collected search volume of roughly 30 different articles, showing that many of them are actually consistent with random behavior. So the mean value is not significantly different from random behavior. Only 3 categories showed significant behavior, taking into account that we are actually performing multiple tests here. So these 3 categories were categories on United States politics, finance, which confirms our previous finding, but also politics. And we didn't label these categories based on these 30 entries by ourselves, so we went actually to Amazon MTurk, and MTurk has actually labeled these categories. So it's a quite surprising fact that these 3 topics historically have had an impact, or the viewing behavior, so the historic behavior on how often people have looked for these terms, have had impact on subsequent stock market behavior. Let me go back to Google and an example where we didn't look at search volume in, for example, in the US in order to link this to the Dow Jones or to global search volume. We wanted to make use of the huge variety and the possibility to look at all these different countries. And Google is operating in more than 240 countries. And we ask the question how we can actually make use of this information in order to quantify something like future orientation of inhabitants in a country. And if we go back to our Google example, where we use company names or we use general keywords, then you always have the problem that if you do this cross-country, then you would need to translate all these different keywords. And one very simple idea to overcome this language silo structure was to look, or to identify first, universally used keywords. And in order to do this, my co-authors, in particular Susie Mote, now also at Warwick, came up with the idea to look at Arabic numerals, so years numbers in particular, which are kind of universally shared in all languages. And this is one example, so that's actually the global example. You see the pattern that in January there's still a certain volume in 2008 for search terms, so for all possible search strings, including the term 2007, the past year. And vice versa, so in 2008, how often people on a weekly basis have looked for search terms, including the next year already, 2009. So that's something which increased over time, so throughout the year. And December, there was a huge increase, so many people were interested or looking for information, in particular search terms, including the next year's number. And what you can see here is that that's a kind of general pattern. In 2009, you find the same for 2010, and looking back to 2008, in the year after, again, that's something which seems to be a very universal pattern, and not only on a universal scale, not only on a global scale. That's something you also find if you look at individual countries. So if you would look up the same figure for the UK, then this would look similar, and other European countries in the US, and so on and so forth. We got interested in the question whether we can really quantify and make something out of this quantification of the ratio. So in order to define a future orientation index, we built the ratio of all searches for the next year, normalized by searches, all searches for the past year. So basically, it's the blue area divided by the red area, and this in every year. And if you do this for all countries for which we have data, then you have to restrict this to the countries where you have reasonable internet usage. So this is restricted to all countries with more than 5 million internet users. Then you find a very striking correlation between the GDP per capita in these countries and the future orientation index, where one means there's the same number of searches for the next year compared to the past year. And by interpreting this, you find that if there are more people in a country looking towards the future, then it's more likely that this country in question has a higher GDP per capita. So it's actually a 0.8 correlation if you use GDP data of the same year, and that's something which was extremely exciting, but on the other hand also opened a bottle of new questions. So what's actually the underlying behavior driving this pattern? And when we published this paper last year in Scientific Reports, together with Susie Moe, Gene Stanley from Boston University, and Stephen Bishop from UCL, then we also provided two hypotheses for this pattern. And hypothesis one is a very interesting one. There might be indeed a relationship between our behavior, so our tendency to look towards the future, and how economically successful a country is, but also a very striking second hypothesis that this has maybe something to do about the internet infrastructure in the country we live in. So in the UK, we have luckily a very good internet infrastructure, and we can organize our everyday life by using our smartphones, using our mobile devices, computers. And so we can look for information in the future. We can book flights to go to the next conference, to book holidays. We can also, and that's the important part, we can find information because there is information for the future, rather than in other countries where the internet might only be used as a kind of historical lookup system, and that's the reason why there is a bias towards the past.
Any question?
Yes, please.
You also look at growth figures. You do GDP per...
So you mean changes in GDP?
Yeah, that's right.
So that's something... So this is these are the findings which are published in this paper, April last year. So based on this, we are working on several extensions. So one extension is obviously to look at changes in GDP, but also to look at other observables. So economic success is one dimension, but many people pointed out that also religion is another aspect which might drive this phenomenon, as in different cultures there are different attitudes towards future and past, and that's just one other example. So there are many other possibilities. The preliminary finding is that actually the link between GDP and future orientation index is the strongest. That's the version we originally looked at, and all other quantities can actually not explain that much variance, but that's work in progress. So another and probably closing case study brings me back to the first slide, our Flickr map, and given this GPS information of all these photos taken all over the world in 2012, generated many research questions, how to link this to real-world behavior, how to use these digital traces. So one very early example actually ignores the fact that there's GPS information, but we analyzed the takes, the titles, and the text bodies of messages, and in particular tried to link this to a recent natural disaster. So we looked at the fact how often how many photos were taken last year between October 20 and November 20, and got labeled in various ways by 3 different keywords. And the keywords were hurricane, were Sandy, and Hurricane Sandy. And if you aggregate this curve over time, and the resolution is actually hourly, so hour by hour, you know how many photos, hurricane-related photos were taken. And the very striking fact is that the maximum of, so the peak of this curve coincides with the hour when Hurricane Sandy made landfall in New Jersey last year. So backed by the fact that if you look at the atmospheric pressure in the US state New Jersey, which obviously goes down if you have more wind speed, then you find that there's a very strong correlation, so Pearson correlation of 0.95 in this area between how many photos were taken and later uploaded to Flickr, and what actually the atmospheric or the environmental state in this country was. I have hopefully demonstrated some evidence based on our recent research examples that large technological systems have become a central part of our society, and that we can actually use it as a worldwide distributed sensor network, in particular if you're thinking of this huge Flickr map. And this tells us something about human behavior on a scale which was actually not possible to reach some years ago. And we worked and we are working on measuring what's actually happening in the world right now. And in some cases, we might be able to also tell you something about the subsequent behavior of complex human systems. Thank you very much for your attention.